Welcome back to Street Smart. We continue now with our week-long series on heavy metals. After dropping earlier today, gold is back up. Well, it's off its all-time high of $1,563 a troy ounce. In April, it's still up 20% over 1 year. And as well as the metal itself has done, our next guest says mining stocks overall usually provide the best return for investors. Dan Denbow is the portfolio manager for the $2.4 billion USAA Precious Metals and Minerals Fund. According to Bloomberg data, the fund has outperformed 96% of its peers over the last 5 years. So, Dan, welcome to the program. Appreciate you joining us.
Thanks for having me.
What's going on now? You know, we were speaking, Adam was talking with Barrick Gold CEO a couple days ago and brought up a chart of the metal versus the stock, and the metal had handily outperformed the producer. Why is that?
Well, it's been a challenging year to own the mining stocks, and as you said, our exposure in the fund, it comes through the mining stocks, not the bullion itself. But they've had several challenges. We started off the year with worries about operating costs, some CapEx blowouts for some projects undergoing construction, and that spooked some investors. And then that was followed up by a lot of political crisis that made people reevaluate the risk and start looking at where the risk is in these companies. You know, they're difficult to operate the mines, and they're not in, you know, such nice places all the time. They're not always in the Nevada or the Canada, and so that has created some worries as well.
Dan, is that what's impacting your fund's performance this year? As we said, you've been a great long-term performer here in like the top 96 percentile. This year, though, you're in the 17th percentile of peers. Is that what's impacting performance? Or if not, tell me what is, and how are you adjusting to kind of make up for that?
Well, it's been a couple of things. Late last year, we started redirecting the portfolio into the larger names, a name like a Barrick or Newmont, moving away from the smaller cap because we thought they were getting a little speculative. People were paying too much for the optionality and not paying attention to cash flows. The mining shares, again, have not performed well this year, but we think that's going to change. When you look at the cash flows coming from these companies, they are starting to increase their payouts, dividends. I think that's going to refocus people to looking back at the miners.
If you think that's going to change, I mean, do you double down now? Because it seems like if you're right, this would be the time to do that.
Well, it is a volatile space, so doubling down is always difficult. Trying to predict the short term is just impossible in the commodity space. But we do think it's a good time to be buying them. And as I said, you know, with these cash flows, as they prove out, and with people raising their dividends, Agnico's a name that we like. They've raised their dividend. They've gone from a 16% annual dividend to an 18% or 18 cent per share quarterly dividend. That's a pretty hefty payout, and they're generating $400 million a year in free cash flow. That's after all CapEx. That's pretty good cash flow, and I think people will take notice of that.
Dan, you know, global instability can be a double-edged sword for you guys. I mean, it drives investors to gold, but it can also threaten mining facilities. So I'm just curious, and you've seen some of that play out geopolitically. How do you kind of balance opportunity with those geopolitical risks?
Well, it's very important to understand those risks, and that's something I think we do better when looking at our companies, is trying to risk adjust the cash flows for each company and understanding where they are and the type of political tensions that can come into play. You know, it's understanding those. A lot of times you don't end up coming in losing them, but maybe you end up paying a few more taxes or some more royalties. But you got to understand what the risks are. We even saw that last year come in Australia, where they started proposing some much higher taxes. Eventually that got rolled back. But even some place like that can be challenging at times.
Hey, Dan, speaking of global instability, you like Centamin Egypt. Why? It's obviously a difficult time for that country.
It has been, and you know, that's one of the challenges, and that creates opportunity for owning those shares. They have one mine in Egypt. They've been developing it. It's in production now, but it has great expansion potential. But people became concerned, you know, after the changes there in government. You still have elections to go through. People are questioning what's going to happen to ownership of the mine, what's going to happen to maybe taxes or royalties that are going to be paid on the mine. So that's created an opportunity. You also, you know, in the mining business, explosives are very important. During the trouble in Egypt, the government wasn't really keen on the mine shipping in explosives into the country, so that set back some of their operations. But that's going to come back around, and we think the cash flows will come through for that company.
Dan Denbow, good to get some time with you. We really appreciate talking to you this afternoon. Take care.
Thank you.